Hello friends and welcome to my channel. Today we will be talking about how to manage your personal finances and achieve financial stability. Finances are an important part of our lives, and proper management can help us reach our financial goals and dreams. Today, we will discuss 10 important steps to financial independence. Setting financial goals, creating a budget, managing debts, emergency fund, investments, retirement planning, insurance, additional income sources, financial education, continuous learning and analysis. Step 1. Setting financial goals. Setting financial goals is the starting point for effective personal finance management. In this section, we will delve deeper into this step. Short-term goals. Start by defining your short-term financial goals. These could be goals you plan to achieve within the next 1-2 years. For example, establish an emergency fund for unexpected expenses. Pay off credit card debts. Long-term goals. Then, move on to long-term financial goals that you want to achieve over a longer period, such as 5, 10, or 20 years. Some examples of long-term goals: buying your own house, planning for a secure retirement, financing education for your children. Specificity of goals. For each of your goals, try to make them as specific and measurable as possible. For example, instead of saving money for a vacation, specify the exact amount you want to save and when you plan to do it. Timelines. Set deadlines for achieving each of your goals. This will help you develop a plan and allocate financial resources. Priorities. Determine which of your goals have a higher priority. This will help you identify what you should focus on first. Realism. Be realistic when setting goals. Make sure they are achievable considering your current financial capabilities. Progress measurement. Develop a system to measure your progress in achieving your goals. This may include regularly tracking your finances and conducting regular reviews. Adaptation. Remember that your goals may change over time. Be prepared to adapt them depending on changing circumstances and priorities. Setting financial goals will help you create a clear action plan and focus your efforts on achieving specific results. This is an important step towards financial stability and the realization of your dreams and ambitions. Step 2. Creating a budget. Creating a budget is an important step in managing personal finances. It allows you to control your income and expenses and plan your financial actions. Let's take a closer look at how to do this. Gather data. Start by gathering information about your finances. This includes data on your monthly or weekly income as well as all your expenses. Understand how much you earn at work, what other sources of income you have, e.g., real estate rental, investments, and what expenses you have. Define expense categories. Divide your expenses into categories. Common categories include housing, food, transportation, health, entertainment, and debt. This will help you understand where most of your money is going. Evaluate expenses. Assess how much money you spend in each of the categories. You can do this by reviewing bank statements and receipts for the past few months. This will help you understand which expenses are constant and which are variable. Set limits. Set spending limits for each category. For example, you can set a monthly limit for food or entertainment. This will help you maintain discipline in spending. Use budgeting tools. There are plenty of budgeting apps and tools, such as Mint, YNAB, You Need a Budget, or even simple Excel spreadsheets. Choose the one you prefer and start entering your data. Track expenses. Regularly track your expenses and compare them with the set limits. This will help you understand where you are spending the most and where you can save. Analyze and adjust. Periodically analyze your budget and make adjustments as needed. If you notice that a certain expense category exceeds the limit, think about how to reduce expenses or reallocate funds. Save and invest. By creating a budget and cutting unnecessary expenses, you will free up additional money that can be directed towards savings and investments. Gradually build up your financial resources. Creating a budget helps you control your finances, avoid debts, work towards achieving financial goals, and ensure financial stability in the future. Step 3. Debt management. Debt management plays a crucial role in your financial stability. Let's take a closer look at debt reduction and management strategies, including credit cards and loans. Understanding total debt. Start by assessing all of your outstanding debts. This may include credit cards, auto loans, student loans, and other forms of debt. Make sure you know the exact amounts, interest rates, and repayment terms of each debt. Creating a repayment plan, develop a plan for debt repayment. Determine which debt to pay off first. It's usually recommended to start with the debt with the highest interest rate, as it will help you save on interest in the long run. Reducing expenses. Try to cut unnecessary expenses to have more funds available for debt repayment. This might involve reducing entertainment expenses or cutting back on restaurant spending. Extra payments. Make extra payments towards your debts whenever possible, in addition to the minimum monthly payments. This will help accelerate the repayment process and save on interest. Debt consolidation. Consider the option of debt consolidation, which involves combining multiple debts into one with a lower interest rate. For instance, you can take out a consolidation loan or use a balance transfer at a favorable interest rate. Credit card repayment. If you have credit cards, aim to pay off their balances in full each month to avoid accruing interest. Lowering interest rates. Try to negotiate with creditors for lower interest rates. Sometimes creditors are willing to reduce rates for clients actively working to pay off debts. Building an emergency fund. While repaying debts, don't forget to build an emergency fund. This will help you avoid taking on new debts in case of unexpected expenses. Financial education. Education about debt and financial management plays a significant role. Explore financial resources and literature to develop your skills. Ongoing monitoring. Continuously monitor your progress in managing debts and adjust your plan as needed. Debt management requires discipline and planning, but it will help you alleviate financial burdens and move towards achieving your financial goals. Step 4. Emergency fund. An emergency fund is a financial safety net that helps you handle unexpected financial crises without resorting to loans or accruing debt. Here's more on the importance of creating an emergency fund and ways to build it up. Why an emergency fund is important. Protection from unexpected expenses. An emergency fund helps you cover expenses such as medical bills, car repairs, job loss, or other urgent financial obligations without taking on debt. Reduction of financial stress. Having an emergency fund gives you the confidence that you can handle unforeseen situations without panic or financial stress. Avoidance of debt. An emergency fund prevents the need to rely on credit cards or loans in the event of financial emergencies, allowing you to maintain your credit history and save on interest. Ways to build an emergency fund. Set a goal. Determine the amount you'd like to have in your emergency fund. It's typically recommended to have 3 to 6 months' worth of expenses as a reserve. Create a budget. Include an emergency fund category in your budget and regularly allocate money to this account. Automate the process. Set up automatic transfers to your emergency fund from your primary account each month. Use tax refunds and bonuses. If you receive tax refunds or bonuses, consider directing a portion of these funds to your emergency fund. Sell unnecessary items. Consider selling unused items to generate additional funds for the emergency fund. Additional income sources. Explore ways to increase your income, such as part-time work, freelancing, or renting out property. Additional income can be directed toward the emergency fund. Cut back on daily expenses. Reduce unnecessary expenses to free up extra funds for the emergency fund. This might involve cutting back on entertainment expenses or reducing restaurant spending. Monitor growth. Regularly review and update your emergency fund, increasing its amount as your financial capabilities grow. Creating an emergency fund is a financial strategy that provides you with stability and peace of mind, knowing that you have resources to address unforeseen financial challenges. Step 5. Investments. Investing is a key element of financial planning that helps grow your wealth over time. Let's delve deeper into various types of investments and their role in achieving your financial goals. Different types of investments. Stocks. Purchasing company. Stocks allows you to become a part owner. Owning stocks enables you to receive dividends, a share of the company's profits, and benefit from the appreciation of stock value. Bonds. Bonds are debt securities issued by governments or private companies. Bondholders receive interest, coupons, and the return of the principal amount upon maturity. Real estate. Real estate investments can involve the purchase of residential or commercial properties for rental income or property value appreciation. Index funds. Index funds invest in stocks or bonds that mirror a specific financial index, such as the S&P 500. They provide diversification and risk management. Mutual funds. These funds pool money from various investors and are managed by professional fund managers. They can invest in a variety of assets, including stocks, bonds, and other instruments. How investments can help grow your wealth. Capital growth. Investments in stocks and other assets can lead to capital growth over time. This can help you achieve long-term financial goals, such as retirement or property purchase. Income. Some investments, such as bonds and dividend stocks, can generate income in the form of interest rates or dividends. Diversification. Investing in various asset types helps reduce risks. If one type of investment underperforms, others can offset losses. Hedge against inflation. Investments can help preserve purchasing power in the face of inflation, as their value may increase over time. Long-term financial stability. Investing is a way to create long-term financial security for yourself and your family. Investment tips. Start by studying and educating yourself about investing. Determine your investment horizon, how long you're willing to invest. Consider diversifying your portfolio. Consult a financial advisor for personalized advice. Investing requires time, patience, and an understanding of risks, but it can be a powerful tool for achieving your financial goals and increasing your wealth in the future.
The first part of the video ends here. You can find the continuation on the channel. Thank you all for watching. See you next time.